it's a method of forecasting the value of a currency. So bear in mind that we are analyzing what the value of a currency, right? We are forecasting the value of a currency before we actually make money from the market. So we forecast that the value of the currency is going to appreciate or depreciate against another currency. That's how you get to make money, right? So when it comes to fundamental analysis, you forecast the value of a currency by analyzing the country's economic, political and social forces, right? So we are looking at things like inflation, interest rate, GDP, and so on, and also some natural phenomena we can say the going to affect the supply and demand of that currency. What will make people want to demand for a particular currency? What will make people want to supply more of that currency in the market, right? And technical analysis, on the other hand, technical analysis is basically you forecasting price based on historical price movement, based on previous price pattern that's happening in the market. Maybe ABC happened last year, and today you're able to see ABC. So you are taking a trade based on the ABC that happened last year, and you see the same pattern happening now. That's what you will get today. The trade, right? So we'll start first with fundamental analysis. So I'll be moving from this screen to what I'll be showing you guys what you actually do the fundamental analysis and so on, right? So I'll talk on the various type of fundamental analysis. So the core idea behind this fundamental analysis is that the currency should appreciate in value if the future economic outlook of the country is optimistic, right? So if people are saying that, let's say we're going to be using the United States as an example in this scenario. Let's say we are looking at the United States and we are seeing that the future of this country, right? The economic fundamentals of the country, they have a positive outlook. So if we see that, then we believe that the currency is going to appreciate, right? And then start having like positive outlook based on the currency, and vice versa. If you are seeing that maybe United States is going to there's going to be war or something is going to happen there, you might not want to invest in the country, like in terms of investment. You might not want to purchase your currency because it's going to depreciate in future, right? So some of the key economic fundamentals that we'll be looking at, and that is starting from tomorrow, we're going to have a lot of fundamentals happening. So if you pay key attention, you're going to see most of that happening. So the first one, we are going to look the most important one. We look at this report. The first one is interest rate. Right. The first one is interest rate. So interest rate. So the higher, so interest rate we are looking at. Let's say, as I take for example again the United States, right? So take for example, if there is high interest rate in a country, what does it mean for that country, right? What will people think? If let's say you're going to the bank, I'm using practical example so you understand. If you're going to the bank and they tell you that okay, there's high interest rate, let's say interest rate today is 7%, people the next day say it's 10%, interest rate is high, right? You are more likely to invest your money in that bank, right? You're more likely like, okay, I'll save my money more, I will not spend the money, right? I'm going to save this money more into the country. Now, the way interest rate work, it doesn't work alone to affect the particular currency. Interest rate work hand in hand with inflation, right? So I'll put inflation by this. Interest rate works with inflation. So when we look at interest rates, so now when there is high interest rate in the country, as I said, it attracts savings, right? So you see more investment go into that country, right? Because people are going to invest money for the savings, so they are the interest rate pulls a lot of people. So now if there's higher demand for that particular currency, because if you are going to the United States to invest, you definitely need that particular currency. Maybe if you're investing into stocks, investing into bonds or any other instrument you want to invest in, right? You definitely need the currency of that country to invest. Therefore, there is going to be a higher demand for that particular currency. Now, when there is a higher demand for that currency, what happens? The value of the currency increases, right? When there's demand for that currency, so when demand tends to increase, people tend to demand more and the price increases. So now we are trading price of the currency. So when you see that the price is increasing, that's when people you as a trader, you actually forecasted this in future. If you actually forecasted this in the past, let's say for example in January, you forecast that there's going to be high interest rate in the United States because of what is happening, and this tends to happen where you're really taking an order to buy the US dollar, let's say today. Now, when you buy this US dollar today, and let's say in the next 2 months, the interest rate tends to increase, people start buying the United States dollar. When you already bought at a lower price, what happens? The price increases, and now you sell at a higher price because you bought at a lower price. Right. So when interest rate increases, it attracts more savings, and the price of the value of the currency goes up, makes the currency to appreciate and against another currency. Now let's take for example the United States dollar. Let's say GBP USD. So if you go to a chart like this, let me open GBP USD for example. Now, so this is a chart for example for GBP USD. So when I mean by the price is going to appreciate, let's say for example, let's say tomorrow the release, we're looking at somewhere here. Let's say for example tomorrow they release interest rate data. Right now we are trading the pound against the United States dollar. So let's say price is currently here somewhere where this green line is. Forget what has happened in the past. Let's just look at this data in front. Right, let's say they release data for tomorrow for the United States dollar. Right, tomorrow they're releasing this. They are releasing interest rate data. Now the interest rate, the data comes at there's interest rate are high, are up. Right, what you tend to see in the market is that the pound will start falling down. Right, the pound will start falling down. So why would the pound be falling down? Right, this is because the pound is trading against the US dollar. It means that the US dollar is appreciating against the pound. Right, so the US dollar becomes more stronger than the pound, and the pound will start falling. That's how you actually trade this fundamental analysis in terms with other currencies. So if you want to look for a USD, better start with USD. So one thing I told you guys to take note of is that when you have a currency like you have this one USD JPY. Now it means that when you're actually buying this currency, if you place a buy order, it means you are buying the USD. You are buying this base currency, right? Using the quick currency. It means you are using your yen to buy the US dollar. When you're trading a currency like GBP USD, it means what? You are using the US dollar here to buy the pound. Right? So how do you read this currency? Let's say 1.25350. Right? Now if I place an order to buy, what does it mean? It means that 1.35350 US dollar will give me 1 pound. Right? So you're buying the pound here, and if you start selling, it means you're selling the pounds against the US dollar. So now, if there is an economic news and it turns out that it's a fundamental like the interest rate, that interest rate in the United States is strong, right? The interest rate are high. Right? What does it mean? It means that it's attracting more investment will be tilted towards the US. So what will happen? The value of their currency will increase. So if the value of their currency increases, it means that the US dollar becomes more stronger. Right? If the US dollar becomes more stronger, what will happen? It start going up. Right? It means that you start buying. You see more buying pressure. People start buying. People start investing. People start demanding the currency. That's why during high impact news, there tends to be a lot of volatility in the market. Volatility in the market is too much. Right? The price moves a lot. Right? That is because people are not purchasing the currency because they've seen the data release that there is a lot of interest. The interest rate has increased. So people start investing in the United States, in the US dollar. It makes the currency to actually go up. Right? And now you start falling against the pound. People start using against the Japan. People are using the yen to buy the pound. So that's why you see if interest is in the United, if they say fundamentals are good for the US dollar, the dollar will be going up. If fundamentals are bad for the US dollar, the US dollar will go down. Yeah. So any questions so far based on what I've said when it comes to interest rates? So if I get your question correct, you are asking if the interest rate are high and the US dollar is strong, why don't we trade the pound USD? Right. So Now, when there is this data, when there is, let's say there is news coming out that is in relation to the US dollar, right? You trade pairs that are only paired with, you trade currency pairs that are paired with the United States dollar, right? You don't just trade any currency pair. So if there's interest, let's, for example, look at my screen. Let me show you what will happen tomorrow is Tuesday. For example, tomorrow Tuesday we have CPI data release. I'll talk about CPI. We have CPI data going to be released, and this CPI data is concerned with what? With the United States dollar, right? So it means that only pairs that are paired with the United States, only currency pairs that are paired with the United States dollar will be affected. Right? A pair like let's say Euro JPY will not be affected by these data, by this fundamental. So this fundamental concerns only the United States. Now, if you look here at 7 a.m. GMT, we are going to have Claremont count change for the United States. This is a high impact news. Anything you read, I was supposed to come in after, but let me just anything you read is high impact news, right? So this data concerns what the GBP, it concerns the pound, right? You see, here it is not be any other, it's not like GBP USD. It's just like for a country, the currency. You see currency and the impact. This currency is a pound, so any currency pair that is paired with the pound is going to be affected by this data you see here. So now we are looking at, I was talking about GBP USD. It means that if there is a particular fundamentals coming out and the interest rate, it concerns just the United States dollar in this case. But since these currencies are traded together, they are being traded together in this case, right? It means that if one is going up, the other one will be coming down. That's what happened. That's what is happening, right? So now, since, as I said, that if interest rates are high in the United States, what does it mean? It means that more investment is flowing to the United States, right? So it means it is good for the currency. It is good for you. Well, I would say it is good for US dollar, right? So if it is good for US dollar, what will happen next? What do you think is going to happen next? It means that more people will demand for the US dollar, right? And when more people demand for the US dollar, what happens? It goes up. The US dollar starts shooting up, right? People start buying more of the US dollar. It means it starts shooting up. It starts shooting up. Now, how will you trade a currency like this? I would like to ask this to anyone to answer. What do you think if the US dollar is good? If these two pairs are being traded, right, and the US dollar is going up, how will this currency be moving? Will it be going upward or will it be going downward? Will it be moving to the downside or will it move to the upside if the US dollar is strong in this particular for GBP USD? Anyone can just answer. Yeah.
So basically the pound will fall and then the dollar increase, the price of the dollar increase.
Okay. So how do you think the price is going to move in? Let me bring a chart. Do you think if the US dollar becomes stronger, do you think this particular chart will be going down like this or will be going up like this?
It will have to go down because the pound to the dollar, right?
Exactly.
So basically buying using your dollars to buy pounds. So
yes,
it's reduced. You're buying pounds.
Exactly. Perfect. So that's what I'm trying to that's what I was trying to explain. Because you're trading the pound and the US dollar. If the US dollar becomes strong, what does it mean? It means that now because initially you're using your US dollar to buy pound in this case, as I said. Now initially, let's say they were 1:1, but you need one US dollar to buy 1 pound. And now a dollar is now very expensive. You need actually let's say $0.5 to buy 1 pound. You know that the pound now becomes weaker. It starts falling because now this particular chart is for the pound. Do you get what I'm trying to say? So if you just put your mind that if the US dollar becomes strong, you are trading pound against USD. The pound GBP USD start falling. Now similar scenario comes with USD JPY, which is the opposite. Now you see that now the US dollar is the main currency here now. is the base currency, and what this one here will happen, it is a core currency. If the US dollar is released now, the interest rate are high, what will happen? You see that now this particular pair will be going up because the pound now is stronger, right? The pound now is stronger. It means you need less, you even need less, you need more of these Japanese yen to buy this US dollar. So you see that what price starts shooting up, right? However, let me just go to the second one first. GDP, gross domestic product. So the second one we're looking at for fundamental is the gross domestic product. So this is like basically in economics, the monetary value of all finished goods and services made within a country, right, over a specified period of time. So now, how does it affect? You might wonder how is this affecting the value of a currency? So the higher rate of GDP serves as evidence of growth in an economy, and thus increase the demand for and value of the currency. So if there's high GDP, it means that what is just portraying means that the economy is performing well, things are going well, so it attracts investment in the country. So remember that what actually makes the price to move forward is that people are having a positive sentiment, people are having a good perception about a particular country, people want to invest in that country, and when they are investing in that country, there is growth. If I see that there is growth in the United States, that GDP is doing well, I want to invest in that particular country, maybe invest into real estate, invest into other things and so on. And in doing this, you need the currency of that particular country to invest in, and you start buying the currency, and the currency start going up. That's how GDP works. GDP is very simple, right? Just like there's higher GDP, and that is going to means all the issue, which means that there's evidence of growth in that particular economy. And if there's growth, what does it mean? It means that more investment goes into the economy, right? If more investment is going into that particular economy, people will demand more of their currency, right? So if they're releasing the data, you come on a particular day, you say, oh, they are releasing GDP data. For example, on Wednesday they're going to be releasing GDP data for the pound, right? On Wednesday at 7 a.m. So if the GDP data comes and is being released at 7 a.m. here, and it's actually good for this, it's just GDP is higher here for pound, but it means that what the economy is doing well, and you say the pound is increasing. If this data actually comes out positive, right? It's the pound is actually doing well, the economy is doing well, so you attract more foreign investment and so on. So CPI. CPI stands for Consumer Price Index, right? So this one tracks the changes in retail prices of goods and services, like of essential goods and services by household, right? And also used to measure inflation, right? So as I was saying, this CPI is not just traded on, say, as I was trying to link it to inflation, so you used to measure inflation, right? So it just basically influences like the changes in monetary policy by the central bank, that they might either have to strengthen or weaken the currency, right? So let's say, for example, as I said, if inflation is high in the United States, what they will attempt to do is that they want to see how they can combat this inflation, and the instrument the central bank will use for this monetary policy is what we call the interest. They will mostly use interest rate to do this, right? So if they see that their inflation is actually increasing, it is going up, right? What they do is that they increase their interest rate, right? So at times you will notice that, let me come to a previous CPI and just look at the previous CPI. Forecast, you see that changes in the price of goods and services purchased by consumers, actual greater than forecast, is good for currency, right? Now you'll be seeing that this is CPI data, this is inflation data. Why would it be doing that actual greater than forecast? It means that people also want inflation, they also want the inflation to be high. What does it mean? It means that if inflation is high in the United States, is good for the currency, because in terms of traders or forex traders, if inflation is high, what they know is that they're going to increase interest rate. That is what is in their mind. That's what is in everybody's mind. That's what they fit is into. If inflation is high, they're going to increase interest rate. That's why they said actually greater than forecast, because before the data is released, they will have a forecast. So for now, we have a forecast here. Data that will release tomorrow at 1 p.m., 1:30 p.m. Right? We have a forecast. The previous one was 0.4%, and we have the forecast now we are looking at. That is CPI month on month. And then for this month we have now 0.2%. Now if this data tomorrow comes out, more if the data the actual if the actual comes out to 0.3%, right? Now what will happen is that it will be good for the currency. Even though it is inflation, it is increasing. It will be good for the currency because the interest rate now will not come as a factor, because they are going to increase interest rate to bring this inflation down. That's what they are going to do. Right now, I'll just leave it here. I'll leave it here for now. I will not go into explain these figures and how to trade. I'll come back to it. But I just want to go through them. So now we are looking at unemployment. So I think for unemployment, it's like everyone will get to understand this one. So something very basic, right? So we are not obliged to trade to trade news. When news is coming out, you can decide not to trade it, right? It's very volatile, so it's not even advisable for some people. At times it's not advisable. I will not advise people to actually trade it. If you know you don't really understand it, it's not advisable to trade it. When it comes to unemployment, basically it's the number of people that are employed like in a country, right? So now since it's the rate, so I'm looking the percentage, the number of people employed, percentage of laborers. So now when there's high unemployment, right? When there's high unemployment in the country, what does it mean for the country? It means the economy is operating below full capacity, right? When there is high unemployment, it means the economy is operating below full capacity. If there is high unemployment, that's what they actually mean, below full capacity. And if the employment is really low, it means that actually the economy is operating at full capacity. The economy is performing well. People have jobs, people have money to spend, people have money to invest. That's the psychology behind employment, to invest and so on. So what happens? The economy is good, right? So we tend to see people flow into that country to look for jobs and so on and so forth. Right? What happens? The currency of the country becomes very good, right? It becomes stronger. It tends to appreciate in value. So the main data you always see, we'll call it NFP, right? So it stands for non-farm payroll. So this NFP is released this non-farm means it's the unemployment data without they don't consider farmers, right? They remove farmers from inside. Just those who are things like industrial jobs, so they don't consider farmers inside this particular data. So these are the major fundamentals we are going to be looking at, right? I just want you guys to pay attention. There are other various fundamentals that you learn about, but they don't really have high impact when it comes to this. Now I'll move to how you analyze this. I've started already.